All right, crypto fans, buckle up, because today we're diving headfirst into the world of crypto charts.
Yeah, that's right. Charts, charts, charts.
We're talking about those sometimes intimidating, sometimes exhilarating visuals that can either make you feel like a Wall Street wizard.
Or have you running for the hills. But
Exactly.
don't worry, we're here to demystify it all.
Think of this deep dive as your crash course in reading those crypto charts.
Like a pro.
Exactly, like a pro. We'll be pulling some wisdom from a podcast episode we found called How to Read Crypto Charts Like a Pro in 2025.
Very catchy title.
Right. Very catchy. By the end of this, you'll be able to look at those charts and say, hey, I know what's going on here.
No more just staring blankly at those lines, hoping for the best.
Exactly. So before we get into the nitty-gritty of patterns and indicators, let's take a step back. Why are charts so crucial in the crypto game?
Well, for starters, think about the volatility of crypto.
Oh, yeah, buckle up.
It's a wild ride. Relying solely on gut feelings or what you see trending on Twitter is a recipe for disaster.
Yeah, definitely not a sustainable strategy.
Charts, on the other hand, they give you this visual history of an asset's price.
Hmm.
Think of them as a roadmap, showing you the trends, the potential turning points, and those oh-so-important buy or sell signals.
Ooh, those are the signals we want.
The ones that can make all the difference.
Okay, I'm liking this roadmap analogy. So let's talk about the language of these maps, starting with the building blocks, those candlestick charts.
Ah, yes.
Yeah.
The candlesticks.
I'll be honest, when I first saw them, I was a bit intimidated. All those shapes and colors.
It can feel like you're deciphering ancient hieroglyphics, can't it?
Exactly.
Yeah,
But once you get the hang of it, it's like a whole new world opens up.
it does.
So can you break it down for us? What exactly does each candlestick represent?
Think of it as a snapshot of price action over a specific period.
Okay, got it.
It could be a minute, an hour, a day.
So each candle is telling us a little story about what happened during that time frame.
Exactly. And each candle has a body and those wicks or shadows.
Right. Those are the parts that always trip me up.
No worries, it's a common stumbling block. The body, that thick part in the middle, shows you the opening and closing prices for that period.
Okay, so at a glance, we can see whether the price went up or down during that time.
You got it. A green body, or sometimes white, depending on your chart settings, means the price closed higher than it opened. Red or black means it went down.
So green is good, red is not so good.
In simple terms, yes. But it's all relative, of course.
Right. Context is everything. And what about those wicks, the thin lines sticking out above and below the body?
Ah, the wicks. Those show us the high and low points the price hit during that period.
So even if a candle closed lower than it opened, a long upper wick tells us that the price made a run upwards at some point.
Exactly. It gives you a sense of that intra-period price action.
Interesting. So we're not just seeing the start and finish, we're getting a glimpse of the journey in between.
Precisely.
Okay, this is making more sense now. And I know that these candlesticks often form patterns that can give us clues about future price movements.
They do. They're like little footprints telling us where the market might be heading.
What are some of those key patterns we should be on the lookout for?
Well, one that pops up a lot, especially in a volatile market like crypto, is the doji.
Doji. Okay.
Picture a candlestick where the opening and closing prices are practically the same,
Ah, so it has a tiny little body.
almost non-existent. It looks like a cross or a plus sign.
I think I've seen those.
Yeah.
But to be honest, I never really knew what they meant.
The doji is a sign of indecision. It means the buyers and sellers are kind of duking it out.
Battling for control.
Exactly. But neither side is winning. It's like the market is taking a pause.
So if I see a doji forming, it's like a signal to pay close attention.
Exactly. See which way the market breaks out next.
Okay, got it. Indecision can be a powerful signal. What else? What other patterns should we have on our radar?
Another one to keep an eye out for is the hammer.
The hammer. Interesting name.
It's a bit easier to spot. It has this long lower wick and a small body. Could be green or red.
Okay, so it looks like the price dipped way down, but then quickly bounced back up, leaving that long tail at the bottom.
A perfect description. And you often see hammers at the bottom of a downtrend. It can be a signal of a potential reversal.
So like a glimmer of hope for the bulls?
Possibly. It suggests buyers are stepping in with some force, pushing the price back up.
And not a guarantee.
Never a guarantee. Remember, these patterns are clues, not crystal balls.
Right. Context is everything.
We always want to consider other factors and the overall market sentiment.
Okay, so speaking of other factors, let's move beyond the basics of those candlesticks and talk about the tools that can help us analyze those charts.
The indicators.
Exactly. What are some of those essential indicators that every crypto trader should have in their arsenal?
Well, we've got to start with the moving average, or MA for short.
The MA, okay, I've definitely heard that term thrown around.
It's a classic for a reason.
But I'm not always sure how to interpret them. Can you break it down for us?
Think of moving averages as trend filters. They smooth out all the price fluctuations by averaging the closing price over a specific number of periods.
So it's like taking the average temperature over a week instead of just looking at one day's high and low.
That's a great way to put it.
Yeah.
We're trying to see the bigger picture, the
Mhm.
underlying trend, without getting distracted by the daily noise.
Filtering out the noise, I like it. So
Yeah.
which moving averages are the most useful in crypto?
You'll see a lot of traders using the 50-day and the 200-day moving averages.
Okay, those are the ones I see mentioned all the time, especially that 200-day MA. What's so special about that one?
It's often seen as a key dividing line
Dividing line.
between a bull market and a bear market. If the price is consistently trading above that 200-day MA, it's generally considered a bullish sign.
So it's like a sign of strength.
Exactly. But if it drops below, it could be a warning sign that the bears are taking over.
Interesting. So not a foolproof signal, but definitely something to watch closely.
Exactly. It helps you gauge the strength of the trend and get a sense of the overall market sentiment.
Ah, okay. That makes sense. So we've got candlestick patterns and moving averages. What other indicators should we be adding to our toolbox?
How about the Relative Strength Index, or RSI?
RSI. I've seen people get really excited about this one.
And for good reason.
What makes the RSI so special?
Well, it's a momentum oscillator. It measures the speed and magnitude of price movements.
Speed and magnitude. Okay, so it's not just about direction. It's about how quickly and strongly the price is moving.
You got it. And what the RSI does is help us identify overbought or oversold conditions.
Overbought and oversold. Those sound like important concepts.
They are. Think of the RSI like a thermometer for the market.
Oh, I like that analogy. So what are the temperature readings we should be paying attention to?
The RSI ranges from 0 to 100. A reading above 70 is generally considered overbought.
Overheated.
Exactly. It means the price might have risen too far too fast.
Like a balloon that's about to pop.
It could be due for a pullback, a correction,
So that's a warning sign.
a yellow flag, maybe not a red flag yet, but definitely something to be aware of.
Okay, and what about on the other end of the spectrum?
Well, an RSI below 30 is considered oversold.
So the market has cooled down a bit too much?
It could be. It suggests the price might have fallen too sharply and could be ready for a bounce.
Interesting. So the RSI is helping us gauge the strength of a move and whether it's sustainable or not.
Exactly.
And you've emphasized that no single indicator is perfect, right?
Absolutely. It's all about using them in combination, getting multiple perspectives.
It's like putting together a puzzle.
Exactly. Each indicator provides a different piece of information.
Okay, so we've got candlestick patterns, moving averages, RSI. What other powerful indicators should we be aware of?
Well, there's one that's a bit more complex, but it can be very insightful. The MACD.
The MACD. Okay, I'll admit that one sounds a little intimidating.
It stands for Moving Average Convergence Divergence.
Okay, now I really feel like I'm in over my head.
It's not as scary as it sounds, I promise. Essentially, the MACD uses two moving averages,
Okay.
a faster one and a slower one,
Got it.
to identify changes in momentum.
So it's looking for shifts in the strength and direction of the price movement.
Exactly.
Yeah.
And specifically, it's looking for divergences or convergences between those moving averages and the actual price action.
Divergences and convergences. Can you explain what those mean in this context?
Sure, a divergence happens when the MACD is making new highs or lows, but the price isn't following suit.
So they're not in sync.
Exactly.
Right.
It can be a warning sign that the trend is weakening, even if the price hasn't fully reflected it yet.
Like a crack in the foundation.
A good analogy.
Yeah.
And a convergence happens when the MACD and the price are moving together, confirming the strength of the trend.
So it's like a validation signal.
Yes, a green light to proceed with caution, of course.
Of course. Always with caution in the crypto world. So we're gathering clues from all these indicators, looking for that confluence of evidence.
Exactly, like detectives building a case.
And speaking of evidence, we can't forget about volume, right? That's a crucial piece of the puzzle as well.
Absolutely. Volume is the fuel that drives price movements.
Okay, so high volume means lots of activity, lots of interest.
Exactly. It tells you how much buying or selling is going on, which gives you an indication of the strength of the trend.
So high volume usually confirms a breakout or validates the strength of a move.
Precisely. While low volume might suggest a lack of interest, maybe a sign that a trend is fading.
Okay, so volume is like the energy behind the movement.
A great way to think about it. It adds another layer of confirmation to your analysis.
This is all starting to come together. We've got candlestick patterns, moving averages, RSI, MAMB, and volume. That's quite the arsenal.
It is, isn't it? And now that we have the tools, it's time to put them to work.
Yes. Time to start deciphering those charts and identifying those all-important market trends.
So let's talk trends.
Yes, the trends.
Yeah.
Those big, sweeping movements that can make or break your crypto portfolio.
Exactly. And there are three primary trends we need to understand: uptrend, downtrend, and sideways market.
Okay, those sound familiar. Let's break them down.
Started with the uptrend, also known as a bull market. It's characterized by those higher highs and higher lows.
So it's like the price is climbing a staircase.
Uh-huh.
Each step takes it higher, even if there are some dips along the way.
Exactly. Each peak is higher than the last, and even those dips don't fall as low as the previous ones. It's that classic buy the dip scenario.
When everyone's feeling optimistic and the market seems unstoppable.
Precisely. Then we have the opposite, the downtrend or bear market. Lower highs and lower lows.
So the price is basically making a descending staircase. Each step takes it lower, and those bounces can't quite reach the previous high points.
Unfortunately, yes. It can be a tough time to be in the market, but recognizing a downtrend early can help you protect your capital.
Absolutely. Better to cut your losses and live to trade another day.
Exactly. And then there's that middle ground, the sideways market or consolidation.
The market is taking a breather.
Think of it as a period of indecision. The price is moving within a range, not really going anywhere.
So it's like that moment of stillness before a storm could break out in either direction.
Exactly. And that's where those support and resistance levels we talked about earlier come into play.
Yes. Support and resistance. I'm still trying to wrap my head around those concepts. Can you remind us what they are and how they work?
Sure. Imagine drawing lines on your chart.
Okay, I'm visualizing it.
Support is that level where the price tends to bounce back up from.
Like a floor, holding it up.
Exactly. When the price dips down to that support level, buyers often step in, creating buying pressure that prevents it from falling further.
Interesting. And what about resistance?
Resistance is the opposite. It's the level where the price tends to stall or reverse downward. Think of it as a ceiling.
Preventing it from going higher.
Precisely.
So if the price breaks through a resistance level, it's a sign that the bulls are in control, and we could see further upward momentum.
You got it. And conversely, if it breaks below a support level, that could signal the bears are taking over, and we might see a further downward move.
Wow, I'm starting to see how powerful these concepts are. By identifying those key levels, we can get a sense of where the market might turn.
Exactly. It's all about anticipating those potential turning points.
And I know that these support and resistance levels often coincide with previous highs and lows, or those round numbers that traders tend to focus on.
You're right. It's not just about drawing random lines. There's a logic behind it.
It's like the market has a memory, and those past price points can influence future behavior.
Exactly. We're trying to understand the psychology of the market.
Speaking of psychology, let's talk about those chart patterns you mentioned earlier.
Yeah.
The ones that can give us even more clues about where the market might be heading.
Ah, yes. Chart patterns are like footprints in the sand.
Footprints.
They tell us where the market has been and where it might be going.
So we're not just looking at individual candlesticks anymore. We're looking for those bigger formations, those recurring shapes that can signal a potential trend change.
Exactly.
What are some of the most common chart patterns that we should be on the lookout for?
Well, one classic pattern is the head and shoulders.
Head and shoulders, like the shampoo.
Exactly. It's a reversal pattern that often signals the end of an uptrend.
Okay, I can picture it. The head is the highest peak, and then there are two shoulders on either side.
You got it. And once the price breaks down below that neckline, which is the support line connecting the lows between the head and shoulders, that's often considered a sell signal.
So it's like the market is building up to this climax, forming the head, but then it loses momentum and starts to roll over.
Precisely.
What other patterns should we have on our radar?
Another common one is the double top and double bottom.
Double top and double bottom. Those sound pretty self-explanatory.
They are. The price tries to break through a certain level twice, but fails, forming two peaks or two valleys.
So it's like the market is testing that level, but can't quite overcome it.
Exactly. A double top is a bearish signal, while a double bottom is bullish.
Okay, so those are patterns to watch closely. If the price breaks through on that third attempt, it could signal a major move.
Exactly. Then we have triangles.
Triangles, as in the shape.
Yes, exactly. You've got ascending, descending, and symmetrical triangles. They all involve the price converging within a narrowing range, just like a triangle.
So it's like the market is getting squeezed, building up energy for a breakout.
Precisely. And triangles can signal breakouts in either direction. An ascending triangle usually breaks out upwards, a descending triangle downwards, and a symmetrical triangle, well, it's a bit of a wild card.
Exciting. So we're looking for those breakouts from the triangle pattern to indicate the direction of the next move.
You got it.
And I've heard of the cup and handle pattern. That one sounds kind of elegant.
It does, doesn't it? It's a bullish pattern.
So we're looking for a cup-shaped formation on the chart.
Exactly. The cup is a U-shaped pattern, and the handle is a slight pullback before the price breaks out above the rim of the cup.
Okay, I'm going to be on the lookout for those cup and handles from now on. It sounds like a bullish signal we don't want to miss.
They can be. But remember, no pattern is foolproof. We always want to consider other factors and confirm our signals.
Right, context is key. It's not just about spotting the pattern, it's about understanding the story behind it.
Exactly. And speaking of stories, let's shift gears a bit and talk about some practical tips for beginners.
Yes, let's get practical. Because all this information can be overwhelming for someone who's just starting out.
Absolutely. One of the most important things is to zoom out and look at different time frames.
Okay, so don't get too caught up in the short-term fluctuations.
Exactly. Don't just look at the 1-hour chart. Zoom out to the daily, weekly, or even monthly chart to get a sense of the overall trend.
It's like checking the map before you start your journey so you don't get lost in the back roads.
Perfect analogy. And another key tip, don't rely on just one indicator.
Right, because no single indicator is perfect. They each have their limitations.
Exactly. Combine multiple signals for confirmation. Look for that confluence of evidence.
Like a detective gathering clues from different sources.
Precisely. And perhaps most importantly, keep your emotions in check.
Oh, that's a tough one. Especially in the crypto world where things move so fast and FOMO can be rampant.
It's essential to avoid impulsive decisions based on hype or fear.
Easier said than done sometimes.
It takes practice. Have a plan and stick to it. And if you're just starting out, consider using a demo trading account to practice your strategies without risking real money.
That's great advice. It's like learning to drive in a simulator before hitting the real road.
Exactly. You can experiment, make mistakes, and learn from them in a safe environment.
And of course, we can't forget about the fundamentals.
Absolutely.
Yeah.
Stay informed about the latest crypto news, market trends, and the underlying technology.
Right, because even the most beautiful chart pattern can't predict everything. Real-world events can have a huge impact on price movements.
Precisely. Technical analysis and fundamental analysis should go hand in hand.
So it's not just about reading the charts. It's about understanding the bigger picture, the forces that are driving the market.
Exactly.
Yeah.
And speaking of the bigger picture, I'm curious to get your thoughts on something.
We've talked a lot about indicators and patterns, and you've mentioned that no indicator is perfect.
Right. They're tools, not guaranteed.
Exactly. So I'm curious about the human element in all of this.
The psychology of trading.
Yeah, we're talking about charts and data.
Numbers on a screen.
But ultimately, it's people making those trading decisions.
It is. Humans are emotional creatures.
And emotions can definitely influence our trading behavior.
Absolutely. Fear and greed.
The two big ones.
Powerful forces in the market. You see a sudden price spike, and that fear of missing out kicks in.
FOMO. It's real.
And on the flip side, a sharp drop can trigger panic selling.
People get scared and just want to get out.
Exactly. Emotions can lead to impulsive decisions.
So even with all these tools and data points, emotional intelligence is still crucial.
It is. Understanding your own emotional tendencies.
Knowing your triggers.
Exactly. And recognizing those moments when fear or greed might be clouding your judgment.
That's where discipline comes in.
And having a clear trading plan.
A roadmap to keep you on track.
Exactly. And that's why I always encourage traders, especially beginners, to start with a demo account.
Practice makes perfect, right?
It does. You can test your strategies, get a feel for the market without risking real money.
It's a safe space to learn and experiment.
Exactly. And as you gain experience and confidence, you can transition to trading with real funds.
But even then, manage your risk.
Absolutely. Never invest more than you can afford to lose.
Golden rule of investing.
And remember, the crypto market is still relatively young.
It's evolving rapidly.
Things can change quickly. Stay informed.
And be adaptable.
Exactly. The more you learn
About the technology, the trends,
psychology,
the better equipped you'll be to navigate this exciting market.
it's a journey.
It is. Well, I think this has been an incredible deep dive into the world of crypto charts.
We covered a lot.
From those basic candlesticks to those more complex indicators.
And of course, the all-important human element.
We hope you found this episode insightful.
and that you're feeling more confident about reading those charts,
Remember, knowledge is power.
especially in the world of crypto.
So keep learning, keep exploring, and as always,
Stay curious.
that's a wrap on this episode of The Deep Dive.
See you next time as we venture further into the crypto universe.
Bye for now.